I want to take this amazing product that's offshore and I want to bring it onshore to Europe and I want to make it universally accessible to retail and institutions. We have the only perpetual futures product in Europe in the next 2 years. I don't think anyone's going to be able to launch anything with contract specs or anything that's comparable to what we're building and what we're launching. Looking at kind of the Bitpanda structure and what they were trying to achieve, and then looking at what I wanted to do with the exchange, the two no longer really kind of felt compatible. Effectively, we bought out and separated those two entities and founded One Trading.
Welcome to the New Money Podcast. You know the drill. Behind me, I've got the Lydian Lion, the oldest coin in the world. I don't think I've told you this, Josh, but this is the New Money Podcast lore. And with me today, I've got one of the folks who's driving this industry, right? And who's hopefully going to help us find out how the future of money looks like. Welcome to the New Money Podcast.
Thank you very much. It's a pleasure to be here and nice to meet you, Lion.
Amazing. So One Trading is this, on the one hand, kind of like next generation crypto exchange, kind of putting it in a very reductive way. And we're going to unpack what that really means in detail in a second. On the other hand, a super interesting kind of like corporate spinout / venture story built on one of Europe's largest brokers, Bitpanda. And you guys rebranded and spun out the platform 2023. You're operating now as a fully separate standalone company and recently raised 30 million from Valar, the folks that led us Series A as well. So we share that connection. And it's great to have you on the show. And I'd love to kind of like jump in with a bit of Josh history. You've had, I think, pretty senior roles at JP Morgan. You went to Bitpanda, now you're founder. Maybe walk us through your last 10 years. How did that happen?
Yeah, it's been a long career, I guess, which feels like a long career. I started off with very dark hair, and as you can see, it's all going grey. So that's probably a sign of the times. But yeah, so I started off in commodities trading. So I'm kind of the strategy consulting world, doing a mixture of market strategy, everything you could really think of. And then, as you say, joined JP Morgan, where I built out and ran our fintech practice. You always say because you leave JP and you just can't help but do that. But so I ran the fintech practice for the corporate investment bank. And so that really involved the digital strategy and also really kind of forward thinking. What were the new business lines that we wanted to be in? What were the areas we wanted to disrupt in the market? And how do we want to position the bank? With that in mind, we did a ton of strategic investment and incubation. I think by the end we were kind of deploying just under $250 million in capital on that, so a fair amount, and really kind of very strategic in terms of like how do you grow JP Morgan to be super successful. And I'd say the net result of that is I built a fantastic understanding of capital markets as a whole. So really, in terms of like retail banking, corporate banking, commercial banking, wholesale banking, and like the different levers and how they play off against each other, and ultimately, particularly in the capital markets world, like from primary issuance all the way through to trading and the different counterparties, the buy side, sell side, and how everything works together in harmony or not harmony at certain points. And so I really enjoyed that. And yeah, look, while I was running that, I had a gentleman who used to work for me in that team who'd actually joined the VC world and was an investor in Bitpanda. And so he put me in touch with the founders there. We kind of had a great conversation. They kind of told me their vision and what they were trying to do. So yeah, I joined as the CEO of the exchange and really kind of spent, kind of a year or so building that out, and really kind of executing on the strategy that, I'll kind of go into in a short while, but executing on the strategy that I thought was the future of the markets at the time. I think, as we all know, market conditions were a bit, a bit hectic, towards the back end of kind of 22, as you had a lot of things going on with, the likes of FTX and others, and really kind of looking at the Bitpanda structure. So kind of talking about the spin out, looking at kind of the Bitpanda structure and what they were trying to achieve, which was basically being the number one broker. And then looking at what I wanted to do with the exchange, the two no longer really kind of felt compatible. So, we had a good conversation on how we could separate the two of them. And as you say, so, I went and raised money and effectively we bought out and separated those two entities and founded One Trading. So that was that. I would say a very different experience to most kind of venture spin-outs or I would say M&A, because the way I always think about M&A is, you buy a company, you bring them in, everyone's incentives are super aligned in terms of, you take this company and you want to merge it and make it part of it. I hadn't really thought about the complexity of, you take a company and you're like, okay, I want to take this company out of a company, but then also, the incentives and the shareholding isn't necessarily the same. And so it's quite a complex thing to do that. I'm really kind of pleased with how it all worked out in the end. But it was there's probably a whole podcast in that in of itself in terms of like, pitfalls, pros, cons, would I recommend it, and various other aspects of it. But it's for sure something that there was a lot of hard work.
I think we're going to hopefully unpack all of it, right? Like your vision for the future of trading, the history
Yes.
of futures themselves, the whole spin-out episode, and starting the company from scratch, and essentially product you've built. I think maybe like before we leave the past and look into the future, maybe the JP Morgan crypto view. How does that feel from inside? I think JP Morgan has always been a schizophrenic, institution in the space where I've got like Jamie Dimon kind of roasting crypto 24/7, and then at the same time the organization is kind of doing a bunch of frontier stuff with Onyx and all these things.
Yeah, I mean, I think you kind of always have to. Certainly, when I was there, I think you have to separate the two, which is there's the digital asset infrastructure and what that can mean, for the world. And so actually, ultimately, it's like, how does JP Morgan play in that space? And you had Quorum, there was Onyx, there was a few other things, right, which were really focused on, particularly in the payment space, so the treasury and payment space. There was certainly kind of a lot of applications where JP Morgan felt that actually being an infrastructure provider and a leader in that was where to go. And then there was the fundamental philosophical view of Bitcoin, and I think that's where, and I think worthwhile separating the employees of JP Morgan and the top of the house in this, which is, I think, obviously there was a very strong top of the house view on Bitcoin, which obviously came from Jamie. And, fair enough, he had his views, and with good reason, if you think about the business model he's protecting and a lot of other reasons why I think that was probably important for him. And then, obviously like dollar supremacy and other aspects of that. But then you also have the employees. There was a joke we always had on the trading floor, and the joke was JP Morgan share price was always going relatively high. There was a comment of, what is going to lead to the mass resignation of all of the traders? Is it going to be the JP Morgan share price hitting a certain price, or is it going to be Bitcoin hitting a certain price? And the underlying there is that obviously, by kind of the top of the house view, there were an awful lot of JP Morgan employees who were heavily invested in Bitcoin. So I think it's worthwhile. I think it's always good to contextualize the two, which is there was obviously this very strategic play in terms of how do you involve yourself in the infrastructure and be a key player in that, and obviously bring the assets that you have to monetize those and grow the influence of JP Morgan and obviously not be disrupted. And there's the other side, which is, value investing, which was just at an individual level, people with their own views and looking to speculate or kind of invest in Bitcoin, which a lot of people were.
And within this whole kind of I think usually you headline it like Bitcoin versus blockchain type debate, right? Like Bitcoin and the individual assets are bad. Blockchain as a technology, it's kind of good. Given your experience at JPM, how bullish are you on kind of a large chunk of the blockchain technology related value accruing in the big banks?
Yeah, I'm super cynical. So I think and I think it's worthwhile separating the two, right? I think I'd almost even take it out of the banks just for a second, right? Which is, I see so much, and even now when I meet with large in big traditional exchanges and other big infrastructure providers, I see so many people doing things with blockchain that's just not, in my opinion, a real use case. So I think there's a lot of stuff where there's a lot of box ticking, and there's a lot of there's a lot of people filling an agenda where they're doing things that they feel is a use case, but so much of it is just not necessary. I mean, if you think in my opinion, where I see blockchain being super valuable and super useful is basically it's the real-time transfer of basically collateral, and that could be in the form of payments, so instant payments. That could be in the form of collateral used to underwrite trading. That could be something like that. It could be kind of the distribution and breakdown of an asset into multiple ownership. But everything, and there are certain things where it really makes sense for that. I'm talking like liquid markets and things where the value exchanges hands like very quickly, constantly. And there are certain things that are illiquid by nature and are very complicated and require a lot of documentation and require a lot of input and rechanging and a lot of that stuff that honestly I don't think needs blockchain infrastructure. But I think we see a lot of people trying to find use cases, particularly in super liquid assets and other things that, are areas that people haven't worked on, and they're trying to solve those. And we're really kind of just talking workflow and databases in a lot of cases, but these have become these huge investment projects for these people. And that's, I think that's where I'm fairly cynical. So I think in the payments world, makes tons of sense, right? Tons and tons and tons of sense. In the trading world, in terms of like a collateral and 24/7 trading setup, like I think it's collateral. I would never use blockchain for trading. I think like as soon as you get to the point where you're trading on a blockchain, I think that's a terrible outcome, because actually having a centralized, like the whole point of like centralized trading is to bring together the best prices and actually have speed of execution and do that in a way that works. So I think it's just finding that balance between, like the right product, the right use case, and something that really solves for something versus, my worry is there's a lot of people building stuff that kind of who cares, and that's and they're kind of sure, we say blockchain and therefore people are like, yeah, it sounds important.
Maybe before we dive into the details, let's kind of zoom out a bit, and I'd love to get your one-on-one on the stack, right? Like give us the one-on-one on the trading stack before we dive into why Bitpanda is a broker and you want to build an exchange, and then the clearinghouse is somewhere under the hood as well. Like how do these things work together, maybe for the uneducated listener, and what's your view on their role?
Yeah, so I mean, I guess let's just take a step back on trading. Then you have, if you think about the infrastructure right now, you have brokers. So broker is typically someone who is like, this is a Bitpanda, this is like an Interactive Brokers, an II, like someone like that. And really what they're doing is they're typically facing off to a retail customer or an institutional customer, though this is like your UI that you go on, log into. And typically what they're doing is they're packaging in some cases. So that means they're taking a product and repackaging it, or they're distributing a product. So that might mean that they're using their access to a different venue, an exchange, or an ETF provider, or a structured product creator. They're repackaging those products and they're distributing back to their end customers. So this is kind of typically the varying sophistication. You can have some more sophisticated brokers that kind of look a little bit like exchanges, but are brokers. And you can have some where it's more kind of a, the Bitpanda style click and trade UI. Then you have like your exchanges. Now in the traditional sense, like you have like obviously your spot exchanges. So they're just trading your spot products. This is listing equities. This could be bonds. This could be FX. And then you have your derivative exchanges. So this is kind of the likes of your, Eurexes, your CMEs, your ICE, like these are kind of listing like derivatives or listing securities. And then you have your clearinghouses. So the kind of the final piece of this is your clearinghouses. This is where basically like collateral margin is maintained. This can be for your derivatives trading and also for your spot trading. And ultimately, that's where the clearinghouse acts as effectively almost like the custodian. And at the end of each day, we'll see what's happening at the exchange, and then we'll transfer the assets between all of the different parties. The thing to maintain in all of this is in the traditional infrastructure sense, or kind of in the regulated infrastructure space, that basically means you have the retail who trade on the brokers and the institutions who trade on the brokers. You then have your exchanges, so your big kind of like traditional exchanges like Eurex and CME, and your clearinghouses. These are institutional only. So what that means is you have to be a bank, you have to be a broker, you have to be a regulated institution to actually trade and participate on these venues. But the three are all very segregated. And I think the other thing that's really important to note in this is the fees are also very segregated as well. So actually it means that if you're trading on one, if you're trading on the broker is paying fees to the exchange and they're paying fees to the clearinghouse. And so you have this like very rich fee model where there's lots of different people taking cuts from different things and obviously kind of monetizing that. And the types of products that are created can be vanilla, very sophisticated. And there's a ton of creativity in the financial market space. So you have this kind of like complex or kind of uncomplex setup, depending on how you look at it. And that's how traditional markets have been to date.
Yeah. So I mean, so much to unpack. And I think, okay, so in the traditional world, you've got the segregated nature of broker, exchange, clearinghouse. Where does this vision in the crypto world come from to kind of like bundle everything up together? So I think we've had like the folks in Europe here earlier this month who are also building a broker and an exchange, but Bitpanda tried to do this under the same hood. Like, what is the rationale? Is it vertical integration and then margin expansion, or what is the thinking usually?
Yeah, so I think first of all, there's two parts to this, right? So I think you have to separate spot trading, which is the trading of the physical underlying. And so this is the example of I'm using my money to buy half a Bitcoin. That is your spot trading. You physically own half a Bitcoin, and that Bitcoin is physically stored somewhere. And then you have your derivatives trading. Now, your derivatives trading, you're not buying the physical underlying, you're buying a security or a contract that represents that. So in that scenario, you might buy half a Bitcoin from a contractual perspective, but you don't have that physical storage of the underlying. So it's a derivative contract that's in place. So I think the first thing is there are two parts to that exchange piece. Now in Europe, you have obviously MiCA that's come through, which is obviously this harmonization of spot trading. And so this is actually, if you think about it, you had all these different countries and all these different rules. And this is how do you bring all spot trading under a single venue? So spot trading and custody, into a single place. So how do we set the rules for trading with individuals and doing that? I guess the bit that I think is really interesting and the stuff that we've been focused on, and the evolution of the market as I see it, is the bit that's really interesting, in my view, is the perpetual futures. So if you go back and you look at the great innovations of the crypto space, I actually think arguably the greatest is perpetual futures, because you have this amazing product. And to go on a bit of a history lesson, it was created in the 1980s or theorized in the 1980s by this Nobel laureate who basically said, I think there is a better way of trading futures. And if you think about the origin of futures trading, you have effectively, it goes all the way back to the commodities space, where you used to have your farmers or your, whoever it is growing corn or growing whatever wheat. And then what they wanted to do was obviously hedge their operational costs, or kind of fund their operational costs. So what they would do is they would sell these forward contracts with fixed maturities to various different financial institutions who would buy them. And then basically the point at which the crop was created could take physical delivery of that asset or sell it to someone else. And they'd basically trade and make money on the difference between, the price at the time that they issued the contract and the time that it matured. Now, that's a great product for commodities, which is obviously where futures originally came from. But then obviously as the financial industry's got more complex and evolved over time, we're seeing, a real change in how those futures are traded. And so what happened is you had this guy in the 1980s who said, maybe there's a better way of trading futures. And this is and we can have a futures contract where there is no fixed maturity. So actually, instead of it being dated, we'll have it constantly rolling, or kind of perpetually in the future. And then actually what we'll do is we'll create these new mechanisms for actually how do we incentivize participants within that. So you have things like funding rates, you have other aspects of that make that a really, really clever product. And then the beautiful thing about crypto is you had all these unregulated venues who are basically offshore going, okay, well, no constraints here. Are we going to offer dated futures for these products? No, let's not. Let's do perpetual futures. This is the product we should do. And so they started launching this, and it's a brilliant product. And it's brilliant in so many ways because it's super intuitive, first of all. So if you think about a dated future, not intuitive at all. In fact, the problem that retail have most of the time trading dated futures is they look at the product and they look at the maturity. So they look at actually what's the expiry in the future. And they go, there's a price delta here. These guys must be charging me loads of money to trade this product, because they look at the spot price and go, well, actually, Google's trading at $50 today, and you want me to pay $75 for this. You're charging me, $25 on this trade. That's crazy. But actually, no, that's not that. It's the maturity premium you're basically paying at that point. And so, I think the problem was it's very hard for, I guess, less sophisticated traders to get their head around this. Whereas you have a perpetual future, and the perpetual future is as simple as cool, I want to buy this because I believe it's going to go up over time, or I want to short it because I think it's going to go down over time, and I'm going to take some leverage with that. And it's such an intuitive product, and it made tons of sense. And you've seen huge adoption of these products. And so for us, that was the bit of, it's how do we take that product and then bring that onshore, and tying this all together with the earlier bit of when I'm talking about the brokerages the exchanges and the clearinghouses, we looked at that and we said, cool, you can't take a perpetual future and make it work well within this model. And it's because all of the incentives and the structure and the regulatory setup are completely misaligned to actually make this work. So 3 years ago, or 3.5, 4 years ago now, my goodness, it's a long time. I went and sat down with a lot of the European regulators and started pitching this vision for, I want to take this amazing product that's offshore and I want to bring it onshore to Europe. And I want to make it universally accessible to retail and institutions. So that's kind of what we did. We took a, frankly, incredibly contrarian bet where we said, actually, this infrastructure, which is what, how other people have gone, maybe you can launch perpetuals of this, will not work. And it won't work because, why should retail be trading via a broker versus trading directly on the exchange and getting the best access to the product? So we wanted to get rid of the broker piece. And then also, we wanted to get rid of the clearinghouse piece as well, because this whole idea of having a separate entity managing the margin and the collateral, which is an institutional only venue, doesn't work. And also, the beauty of a perpetual future is you can settle it real time. So if you're settling it real time, then the incentives don't exist for the clearinghouse to hold this capital. So you're never going to get a clearinghouse to agree to do this product or in a way that makes sense for retail or institutional customers. So we went to regulators and said, hey, we have this vision, this new world vision for trading futures where you take this great product, we consolidate all of this into a single regulated venue where we do product creation, trading, settlement without the need for external clearing in the most sophisticated risk management system and solution that's ever been built in the traditional world. And here's how we're going to launch these products. And look, that's what we spent 3.5 very long years with ESMA, the ECB, the AFM, the DNB getting that done. And that's what we've brought to market this week. So it's been a long journey, but that's the history and the where we are now.
Yeah, the history of futures, man. And congratulations on bringing it live. Can't wait to trade. How did regulators react? Were they thankful that you're finally onshoring this? Because as you said, right, it has been one of the most popular products since, I don't know, since BitMEX times. And it has been lots of the price discovery has happened. How was the reaction? Were they happy by default or were they critical? What's the view?
Yeah, honestly, I mean, they were, I think they were excited about us bringing a regulated offering onshore. I think that's the first thing. So I think that was the overarching. If I think about the unifying thesis at the beginning, when we sat down and said, okay, what are we doing here? We're trying to bring this onshore and make it regulated. So I think we're all on the same page there. I think there was initially a lot of reticence on the kind of the model we were proposing, because effectively, moving away from a cleared derivative trading infrastructure is a very big thing. So actually moving away from that model is complicated. And then I think by the time we'd finished, we reached a stage where the regulators were confident that actually, without putting words in their mouth, this is the future of derivatives trading. And I think it's that full circle of excited about the retail. Is this a viable way of doing it? And then by the time we got to the end, and they really understood the model and how it all worked, I think it's a new excitement. And the new excitement is this is how every derivative, should and could be traded. So whether it's a, crypto derivative and equities, whether it's a fixed income derivative, this is a super capital efficient and nice way of trading where you're reducing counterparty risk and you're giving all your customers the best outcome from a trading perspective. So I think that's I would say, but that's not without the fact that there was 3 solid years of hard work in there to get to that stage. So it wasn't always plain sailing.
Maybe a bit of a ready question, why bring it onshore? Is it a pure trust game? And are you kind of exchanging functionality and speed for trust here? Is that the play, or are there new things you can do with the offshore license?
Yeah, so it's a couple of things. So we're not exchanging functionality. We're in fact, I think we're speed. I think we're actually the fastest venue in the world in terms of certainly in spot trading, and we'd expect that to be true in the derivative space as well. Functionality wise, we're pretty happy with that. I think the advantages it brings. I'll give you a few, right? So it means that people onshore can actually start using their balance sheets. If you think you're a big institution and you have your balance sheet onshore, you can actually use that. It also means that if you're a retail or institutional customer, you have full bankruptcy remote setup. So what that means is we're never counterparty to any of the economic trades. So if someone blows themselves up, trading, like, then we have the procedures in place to deal with that, and they get liquidated and they go through our normal risk management waterfall. But at no point are we taking economic risk. So at no point are we in a position where we're like, hey, sorry, FTX users, it turns out we were market making these trades or taking positional risk or, bailing people out. And now we have like a X billion-dollar black hole that we need to fill. And by the way, that's far more common in other offshore trading venues as well. Like, that's not just FTX, and there's different ways of doing that. And so, I think that's a really important thing that we're not doing that. And then the other thing is, like, because we're not stopping at crypto, the other big advantage of this is, our goal is to later this year launch, like, for example, US single stock equity perps and equity index perps. And we continue to do that. So actually, the nice thing is, actually trading on our venue, you're going to have access to everything you want to trade. So, instead of having to go to one venue to trade your equities derivatives and another venue to trade your crypto derivatives, you're going to be in a position where you can do it all in a single venue, where you're using the same collateral as well. So you can fund it with your Bitcoin, you can fund it with your equities, you can fund it with whatever. And it becomes a single, again, like, super capital efficient way to have a single portfolio view of, like, all of your trading. So I think it's not compromising on the functionality and bringing a lot of protections, but then also opening up a whole plethora of new products that you wouldn't be able to trade offshore because an offshore venue couldn't trade listed securities. So, like, actually it brings all of these assets together in a single place. So I think, like, fundamentally just better in every scenario. And because retail institutions are trading together, everyone's accessing the best liquidity.
FTX actually play in your kind of ideation space. I guess you kind of started out right in the middle of it, basically. What was this immediate response? As in, hey, no, we got to, like, on the one hand, these products are immensely popular, but look what's happening. We got to onshore them, or how do you think about that?
Yeah, it's interesting. So FTX actually had very little impact in the product itself. I think I kind of look at that and go, I think there were so many people doing different things. So what I mean is, there wasn't these guys are doing this offshore, we need to do it onshore. I think it was just a case of, it's really complicated to solve how you do this onshore. And my firm belief is that was always the way the market was going to go, because it is, anything that's mainstream and like that is increasingly going to come under regulatory scrutiny, and the regulators are eventually going to get to the point where they don't want people trading these products in areas where they're going to get hurt, which is what was happening. And so you're seeing that now, the regulators really forcing through this kind of structure. We should do this in a particular way. I think where FTX probably had the biggest impact on me in particular was they just built a very good product. And so what I mean by that is, it's like, actually the user interface experience, the setup was really good, and they did it with a really small number of people. So I think actually what my takeaway from that was less, what are they doing in terms of, like, the derivative products and other things and market making and various things. It was actually, they brought a lot of good product to market with a talented small group of people. And I think that's just more of a good way of building companies. I think it's probably a slightly different takeaway than most of the people from that experience.
Yeah, no, I appreciate that. Like, FTX as a company building role model.
Yeah, I mean, probably should have invested a lot more in their governance framework and a few of the aspects there. But I think if you look at it from a pure technical solution, I think that's where I was like, actually, I think they probably had the best technical solution in the market.
Yeah, let's zoom in again on Bitpanda setup and where we're coming from. So basically what you're saying, right, the vision here is you've got these three components, right? You've got broker, exchange, clearinghouse, the original kind of like futures infrastructure built on data, futures not built, sort of perps, and you guys are rebuilding that. If you think about the early days of kind of like the Bitpanda setup, and they are a broker, right? And they were trying to build an exchange. Why did you feel that didn't work out anymore and you had to kind of like stand it up as a standalone company?
Yeah, I think kind of a few different aspects to that. I think the first is building and running kind of exchange setup like that is it's such a specialist skill set. I think actually, you're talking quant engineer, talking You're talking, people with like, in our case, we've got a lot of people with, high frequency trading experience, market making experience, risk management in complex and unlikely scenarios. I say we're much more almost like a trading house in terms of the people we have. Like it's a small group of incredibly talented individuals. And the problem you have with that is that there's also kind of an expectation. I think when you're building something like that you need to be there kind of 24/7, like building something. And you also have a situation where the product itself is so nascent that you have to, it's almost you're creating a business, right? And you're at that kind of early stage. I need people to hustle around the clock to build this incredibly complex setup with very talented people. And the thing you have with Bitpanda is a much more mature organization with, at the time, more than 1,000 people. And so you have, a much more of a kind of a big corporate much more of a kind of a big corporate mentality because the company's more mature, much more of kind of a big tech, dare I say it, kind of mentality, and in terms of like the skill set and a lot of that. And so it's difficult, if I think what we found is that the two personality types and skill sets weren't compatible with what we wanted to build. And so, from that perspective, I think it made sense to have the breathing space and the cultural setup and the approach to kind of break away and do that. And that's not to say Bitpanda was bad. It's just that it was different. And, for what we needed at the time, we just needed something else. I think like for what they were doing, it's probably absolutely the perfect setup. And they've got some very talented people there. I think it's just a case of, it wasn't the structure that we needed.
To take away from that in kind of like a competitive dynamics point of view, like who are you, if anyone, who are you afraid of in this market? Is it then maybe more like the Jane Streets of the world and then the shops that actually have these teams that you're kind of like describing?
Not at all, actually. So I think look, if I kind of look at our model, like in my opinion, I think we've got the best. I mean, like, well, let's take a step back. We have the only perpetual futures product in the market right now in Europe. So the only one live. You can't trade a perp on any other platform. So that's the starting point. I actually think of any venue that's going to launch anything in the next 2 years, I don't think anyone's going to be able to launch anything with contract specs or anything that's comparable to what we're building and what we're launching. And I think that's by the nature of our setup being very differentiated from what people are doing. And so for me, actually, like my goal is to just get our product in as many people's hands as possible. So, I love that if people come and trade directly on One Trading, you can do that. But we're also doing plenty of partnerships with a lot of large brokers and other platforms and traditional exchanges and other people who will be integrating and then offering our products to their customers as well. So, I think from that perspective, like our goal is to just get, as much distribution on these products. And there's another element as well here that's really important is if you think about how the vast majority of retail consume derivatives in Europe and the UK at the moment, like it's a mixture of structured products and CFDs. Now, CFDs are terrible products. I mean, these are just like the garbage of the derivative world. And I mean that in a sense that like you go onto like any website and it's like, hey, you have to have the disclaimers. The disclaimers are always like 80% of people lose money trading CFDs. And it's like, that sounds like, yeah. And it's like, that sounds like an awesome product, right? I'm literally like, I'm going into it and I'm like, cool, step one, 80% of people are losing money. And it's because you have all of these like hidden fees that are baked into the product, like your overnight margin rates, like all of this stuff that you have like spreads that can be added, like it's super intransparent, right? And so, for us, it's like the other big part and why we see our distribution model being particularly important is, it means that we can offer a product that's like a CFD in that it's intuitive. But actually, with our product, 50% of people make money and 50% of people lose money. And that's because it's a lit order book that you're trading in. So if you make a good trade, you pay the trading fee to trade. And then if it's a good idea, it goes up. If you got it wrong, it goes down. There's none of this like all these little extra fees that erode your gains over time. So you might make a great trade, but actually, because the house is so stacked against you, they're just clipping away all the money you're making on that trade. So it's really hard to be successful. Like this is you make the trade and if you're right, you make money. If you don't, you get it wrong, you're going to lose money. It's as simple as that. And so, we're seeing a lot of people looking to work with us simply because it's actually a really good hedge to providing CFDs because the regulators don't like CFDs and it's understandable why they don't like CFDs. So actually, I think from that perspective, you'll see a lot of big CFD providers getting into the space and actually offering products like ours, kind of like packaging up our products or offering them directly as an alternative. So we're pretty confident in that kind of distribution model. And that's kind of how we're how we're going to play it. And so I'm super excited about the crypto perps we're launching, but I'm also super excited about getting into the equities market and really going after these CFDs and other crappy products that are just ripping people off.
If you think about kind of like perps as the good guy alternative to CFDs, and then also your model being like regulatory innovation at its core, how did you think about setting up regulatory shop, right? So you guys are regulated in the Netherlands. You have a lot of team in Italy. How did that thought process and decision-making process go? Like, did you go to the Italian guys as well and run like a regulator RFP? Or
yeah, so actually it was quite simple. We actually only have a couple of guys in Italy. So actually we set up the Italy setup when we got our virtual asset service provider registration shortly after we did our carve out. And that's for spot trading and custody. We actually, when we were looking at derivatives, derivatives is hard, and finding a regulator that really understands the space is complicated. But we looked at it and look, if you were to go into ChatGPT and or Gemini and Google where have the most OTFs and MTFs been granted in Europe, the answer is the Netherlands. And the reason is because and this is in the traditional world, they have a really good understanding of trading. They have a long-standing history going back to the infamous the flower wars and everything else that they have traded for a long time. It's a trading nation, and so their laws, their understanding are kind of second to none. And so we met all of the kind of larger regulators in Europe, and we kind of discussed our ideas and what we wanted to do. I think what was super clear is they were going to be collaborators in it. And so I felt more going into that process that going with the Dutch regulators, it's a tier 1 jurisdiction. So we know we're going to be able to passport our product all the way across Europe. They really understand the laws and the setup. So we're going to be able to have like a good, well-articulated dialogue with them where they can kind of come back and say, yes, this works, this doesn't work. And I think, some of the other, I guess, kind of regulators I met, I definitely got the impression that it would be a case of we'd fire an application over the wall, and then like a year later, we might get a response, but you weren't going to get that collaborative back and forth. And so given how much we were trying to reshape the regulatory infrastructure for this product, we needed someone who was going to be a collaborative partner, and they were the right ones. So yeah, I think it was the right move. I have a huge amount of respect for them, and I think they put us through our paces, but in the end, I think we all ended up with a really good setup.
And if they were the best, who was the worst? Who was the least collaborative?
I couldn't comment on that. I don't want to offend anyone in the European space. But I'm sure anyone who's been working in the industry has good ideas who might be some of the more challenging ones to work with.
Amazing. So we've got only a very positive CEO testimonial towards the DNB. Shout out to the Netherlands.
Yeah, AFM and DNB. Yep.
No, amazing. Hey, thanks for leaning into all of these kind of like basics, one-on-ones, and advanced questions. I'd love to wrap it up with a bit of a quickfire round. And Josh, if you had to be the CEO of a different fintech, which would it be?
Revolut.
Why that?
I think they're super innovative. I think they're doing some awesome stuff, and they have built a company where they're plugged into so much of the infrastructure, but are yet able to launch and build new offerings very quickly. I'm super impressed with how they're scaling that. Like, if you'd asked me a year ago, I'd have probably not said them, but like just watching them over the last year and seeing kind of their new bets coming through and how they're now taking on private banking, and even what they did in crypto is unbelievable. Like how much revenue they built from that. I'm super impressed with their approach. It's quite hard to argue against what they're doing at the moment.
Something you've changed your mind on about recently?
Donald Trump. I don't know. I guess I was kind of hopeful that there may be some good economic wins from how they were. Like, forget the politics. Like, I thought maybe there was some good economic setup there, particularly in what they're doing in Doge. I think I'm probably more skeptical now of them actually getting some realistically positive outcomes from any of that Europe might be able to copy or use. So yeah, I'd say that's probably one.
What's the biggest short in public markets right now that no one is talking about?
The one for me is like SAP. Like it's an interesting one. I hadn't really thought about this, but I was in Austria recently and working near their building, and someone was telling me kind of what their market cap was and how big their business is, and they're explaining it in the context of, well, for a lot of people seen as kind of the AI Europe's like leading institutional like distributed AI player. And I was like, I don't see that, because I think if I look at how a lot of my team are building tech and other people right now, and how, you're seeing a lot of AI being so independent in terms of how it's distributed. I don't see that at all. So I mean, I don't know if that argument holds true, then I think that's a company that you're going to see a lot of disruption over the next couple of years. So I'd probably short that.
Man, there goes my country's biggest market cap company.
Sorry, man.
Josh, thank you so much for coming here. And all the listeners out there, we're doing this every week. So tune in next week for another round of crypto conversations. And until then, see you soon.
Cool. Thanks. Cheers, mate.